Hey guys, Brian Stevens here with the National Real Estate Post. I've got Chris Martin once again, who is the co-CEO over at Oaktree, who's our favorite non-QM lender out there. You guys need to be working with him. How we doing today, Chris? You're the best?
We're the best.
You are the best.
Right.
Well, okay, can we qualify that? Can we actually qualify that? I think we kind of can, can't we?
Sure, I think so.
Yeah, I do too. So let's kind of go through this whole thing. How long has Oaktree been around?
Oaktree's been in business since 1989. It was founded by Ray Scott, and he started it in October of 1989. He had a business partner that started the mortgage side, and then his business partner left, and he was running a real estate company. And the purpose of Oaktree to begin with was to give real estate agents premier service. So as the company evolved and things grew and the markets changed, he focused less on real estate and more on the mortgage side, providing excellent service to real estate agents. And then as things grew and evolved and different loan officers were at different places, he started doing wholesale and things like that. And then the crash happened in 2008, and he kind of hunkered down and got a little smaller, and they started doing reverse mortgages, and he kept his core team in place. In fact, we still have his two sons. One of them retired now. His other son still works with us, handles a lot of our fundings. One of the underwriters that's worked with him for 20 plus years is still here. So there's parts of the core team that we still have in place today. And then my business partner, Steve, and I came on board in, I think it was 2012, and we started regrowing the wholesale channel. In 2014, once non-QM really came back as a thing, and we got immediately involved. We learned all about all the different rules and how to go about originating these loans, and how we handle ATR and things like that. And so we've been doing this as long as anybody has. This wholesale as long as almost anybody in the business that's actually still in the business.
Right. And listen, we've seen over the past couple of years since we've been working together, we've seen those moments of attrition with non-QM where a couple of the players, the big players, they couldn't hold on. And you've made it through the hard markets, and you guys have made it through the good markets.
Right.
And I think something that I want to point out, I don't know if you will, but I know how rate sensitive you guys are, and how important that is to loan officers. And I know that you guys have always been very aggressive with your interest rates, trying to provide not only the best service, but also the best products and price for LO.
So last week on Tuesday, we lowered rates 3/8 ahead of the rate drop. On Friday, we lowered another 8, so that's 50 basis points last week. And then yesterday, we lowered rates on investment properties another 50 basis points, and on everything else a quarter. So between the two, we've lowered rates 3/4 of a point, 100 basis points in the last 2 weeks. The market hasn't moved that much, but we see opportunity there. So we want to be the lender of choice for those that are looking for those loans. We have a huge appetite for DSCR loans right now. We're really seeing a lot of growth there. We have a great program set up. You know, we can do on a case by case basis. We can actually go below 0.75, but if you're as low as 0.75 on your DSCR, you know, we can get the loan done 75 LTV. If you need to get to 80, not a problem. Just need to have that one DSCR ratio. We can do cash out, rate term, purchase. We can do portfolio loans, meaning we can combine multiple DSCR loans together. So if your borrower is struggling to make 15 different payments, we can help them just get that down to one monthly payment. Yeah, we've a lot of programs, interest only, like we always talk about. Want to maximize cash flow for our investors, with lots of opportunities there for an investor. So we're really aggressively going after those programs. Bank statements, nothing's changed. 12-month bank statement programs. We get your income qualified for you up front. We have a lot of our guys that are trained to help you guys identify those. Interesting point of fact, we actually have more loans right now, and I'm sure this is probably something you want to talk about. We have more loans right now pre-approved than we have in our pipeline. So we have more customers that are ready to go. Their income's approved. They're ready to make offers on houses, but they're just waiting for the rates to drop. So we've been doing what we can to kick them over the fence by saying, hey, let's just drop our rates now and get the loan locked in.
Wow.
What a lot of these customers need to understand is that, look, rates are going to go down at some point. We think probably within the next 6 months, we're going to see rates reasonably in the 6s, maybe even the 5s again. Who knows? But if they wait to buy a house until then, their payment's not going to change, because the price of the house is going to go up, because the inventory isn't going to get any bigger. It's going to be more expensive.
I really hope people understand that. That's a hugely important point. It's something I talked about, Chris. I said, okay, let's have interest rates go down to 1%. Pick a rate that's going to get you off the fence. It doesn't matter, because with our lack of inventory, people are going to qualify up to their maximum allowable payment, regardless of where that rate is.
Well, and here's the thing. I mean, like, I think reasonably, right? Like if rates go below or go back to 3% or 2.75% or whatever crazy prices they were, I think you'll see inventory open up, because there's people that are in houses right now that are thinking, man, I'm in my house, I've got this low rate, my payment's low. If I move, I'm not going to be able to afford the payment. The rate's going to be too high, or I can't buy more house. I can't buy a bigger house for my family. But if rates drop to 6, they're still going to make the same argument. There's just not going to be as much inventory out there. No one's going to move. No one's going to sell their house, because again, they still have 3 points below the market on interest rate. Not to say that there's going to be things people are going to they're going to want to buy a smaller house, and their kids get older. So over time, over the next 10 years, inventory will come back up naturally. But if they're waiting for that to happen, it's not going to be in the next 6 months.
No.
So if you're on the fence about buying a house, we said this I think a year ago, and it became cliche: date the rate, buy the house. You can get in at 8 if you can afford the payment at 8 or 9, whatever the rate is. If you can afford the payment, buy the house, get in. When the rates go down, take advantage of the lower rates, refinance and get yourself a lower payment. But that house that you're looking at, that $450,000 or $500,000 house that you're looking at, or $750,000, whatever your market is of a house you're looking at, right now, the second the rates go down, that house is now going to go up $50,000, $100,000. It's not going to stay at $450,000 or $500,000 or whatever it is. It's going to go up because there's going to be more buyers in the market, because now the rates are where we want to buy a house. And that's just going to cause more pressure on the existing inventories to go up in price.
I'm going to see if I can find this graph that I saw in my Reddit feed a couple of days ago. And it was really shocking to me. It was incomes from the 1960s to today versus rents. And it looks like the side of the Eiffel Tower. It's unbelievable, rents versus where our incomes are. And I think loan officers kind of miss the opportunity here to get back to our basics with some of our marketing. People don't like these rates right now. We get it. Date the rate, you date the rate, you marry the house type of thing. But, not lost on us here is whatever your payment is on that house the day you move in is the most expensive that payment is ever going to be, because you can always refinance it down. That is the most expensive it will ever be. If you can hang on month one, your situation is going to get better because inflation is going to hit. You're going to get pay raises, all of these things. And then, of course, as rates come down, your payment will drop. On the flip side of that is whatever your rent is today, this is why I want to pull that graph up. Whatever you're paying in rent today, that's the cheapest it's ever going to be. In one scenario, this is the most expensive it'll ever be. This is the cheapest it will ever be. Like this is the decision that we need to put in our borrowers' hands and let them know it's one of these two. And I do have a couple of questions for you right now with hearing from some loan officers. If you have like a DSCR loan, and by the way, your DSCR loans right now, guys, if those things penciled today, do you know what they're going to look like a year from now?
And when do investors sell investment properties?
They don't.
When the cap rate, they sell them when the cap rate, right, gets to a certain point, and where they'll get the rents to a point, the cap rate's at a certain point, and then they're going to let them go. So go ahead, to your point, they can refinance that down. They can pull cash out by other properties, and they're going to be able to sell them when the cap rate gets to a certain point. So that's when they're going to be able to capitalize on those gains. There's borrowers right now. I mean, investors are hot, and if they're smart, investors understand that even if there's going to be a small correction in the housing market, which maybe in the interim 6 months there could be, but it's not going to be long term, because as soon as rates go back down, it's going to go back the other direction.
100%. Now, that's one of my questions I had for you. Like, if you do a DSCR loan at today's rate, what happens if rates go down 6 months, a year down the road, and your DSCRs are your rates 2 points lower? Can you refinance those?
Absolutely. So it's going to depend on the situation, right? So if your customer needs the absolute lowest rate right now and needs the absolute lowest payment to make that DSCR pencil, you're going to be a bit more aggressive. Those loans do come with prepayment penalties, right? So our standard rate sheet prepayment penalty is a 3-year 5% prepay. Talk to your account executive. Depending upon what the structure of the deal is, we can do a 3-2-1, so meaning a declining prepayment penalty. So starts off at a certain level and then it declines over a period of time. Or if they are pleased with the cash that they're locking in, then they need to a longer duration, harder prepayment penalty, in which case the customer gets the absolute lowest rate possible. Depending upon what the market does and depending upon what your rate does, is it worth it for your borrower to pay the prepayment penalty to get a lower rate? Quite possibly, very well possible. So it just depends on their situation.
What type of rate are we looking at? Like, what's the difference in rate if you're going to go with a hard prepay on there? Like, what's the difference in rate?
If you did a loan without a prepay, it's about 100 basis points worse than if you did a loan with a 3-year prepay. And if you went from a 3 to a 5-year prepay, it's about a quarter to 3/8 better. So it just depends.
But so outside of your prepayment there, your DSCRs could be refinanced just like any other one.
Yeah, you can refinance it the next day. There's no other prohibitions. There's nothing specifically saying you can't refinance.
Now, with some of your second homes, investment homes, I've been hearing loan officers talking about an increased level in fraud. Like, for instance, people buying second homes, actually making them investment homes, things of that nature. I'm just kind of curious from from your standpoint dealing with non-QM loans. Has desperation created an uptick in kind of some shady files that might be coming in?
We wrote them. We don't like second homes for a couple of reasons. From a risk standpoint, not that we don't do them, we do them and we're aggressive on them when we can be. But from a holistic approach, I understand primary residences, we understand investment properties, and we understand second homes. And second homes are generally those homes that are going to go first. So we underwrite those a lot more carefully than we underwrite an investment property and then we underwrite a primary residence, because we're concerned about people letting that house go too soon. So we don't get caught with a lot of that, knock on wood, but we're cognizant about it. We look at what area the home is in. We look at, is it being put in an LLC? Is it, where is it at in relation to where the customer lives? Those types of things. And if it's if it's an AirDNA or Airbnb or whatever the case is, we look at a lot of that kind of stuff.
So how do you?
And by the way, the rate's not much better.
Oh, really?
Our rates, I mean, for the most part, you could probably stack our rates up next to each other for primary residence investment properties, and they're going to be pretty close. And we have hits for second homes. So, and because of the prepayment penalty, our rates so many times are even lower than second home interest rates. So
I think the ship has kind of sailed a little bit, but I'm just wondering how lenders have kind of dealt with the whole idea of second homes and Airbnbs in particular, because that was all the craze for some time. There's nothing in any of your products that says if you have a second home that you could occasionally use it as an Airbnb, or does that make it to our docs at all?
If the second home docs say that you're going to occupy it, less than half the year or whatever the case is. If you bought it with the intent to rent it out, there's nothing we can really do to stop you from doing that. And it's actually going to make it more sound for us again, because you've got income coming on it, right? So there's nothing specifically that says you can't do that. There's nothing specifically that says that you can buy a primary residence 3 months later, decide that you want to rent it out. I mean, there's nothing prohibitory per se. People change their minds. That now, it's fraud is all about intent, right? So if you intend to defraud and you intend to deceive, that's when fraud comes into place. But if it's a primary residence and you decide and you're in there and you get to see another deal on another house, that's your dream location, you got to put a great offer in on it. We can't stop you from doing that. Where you run into issues is that we get a second home and they're like, hey, they're at 53 debt ratio, and they're like, hey, well, I plan on doing this as my as an investment property halfway through the year. It's like, what? Hold on, we're just going to do this as an investment property, full doc, because you might be occupying it at some point. But this is how we make sure that everything's protected. So we wouldn't do a DSCR program, because our DSCR program specifically prohibit you or your immediate family members from living in the house ever. So, and you sign a document.
And that makes sense too, because what that would compromise the asset in your eyes.
Yeah.
Essentially, because you're offsetting, you're taking away your income, you're taking away a potential rent there, correct?
Well, there's that, and then also there's TRID, right? Because you can't do a stated income loan on a primary residence, and we're not qualifying the borrower, and that's that we have seen that, and there are specific measures in place for us to make sure that we're not being adversely hit on those types of transactions. Like people that can't afford to buy a house or can't document their income, they do a DSCR loan on their, will be a home that they plan to move into. And we find that those things, hey, why is the mortgage statement going to the same place that this is supposed to be an investment property? That's when we get the red flags for occupancy fraud. And that's a problem, right? Because that's clear intent. They signed documents. We specifically said they were going to do something. And then that's when, that's when trouble comes. So
I've had a number of different conversations with loan officers recently, and people who've been finding success with some really extraordinary numbers that don't even make sense to me. It's like, all right, well, what are you doing? What are you doing? Two things that keep coming up to me that I keep hearing is education. So it's, for a loan officer, it makes sense. If you're putting yourself out there, good stuff can happen. And so your icebreakers is going out and basically talking programs with agents, and they're finding remarkable success with it. Numbers that don't make sense to me good. And then the other thing that keeps coming up is niches. People who've got they're digging into one specific component that their competition isn't doing and really exploiting that opportunity. Non-QM is that's what it's all built for in my world. What programs right now, have you seen like anybody taking any of your programs, creating a niche opportunity to exploit the markets? Which one of your programs seem to be outpacing the other ones right now?
Our investment property programs are what most people are using to go out and create that niche. We have a number of loan officers go after those cross-collateralized deals, those portfolio blanket loans, because before, like literally like 2 years ago, that was like a product that was like taboo almost, like, oh, banks do those and super commercial, companies do those. Now they've become simplified. They've become able to be done as regular, Fannie Freddie type mortgages almost. The qualification with taking DSCR loans and say, okay, we could do a DSCR loan. Can we also do cross collateralized deal? It's like, oh yeah, well that makes sense because now we're still qualifying off the income of the subject property. We just do it multiple subject properties, not just one. So that's been a big hit from a niche perspective. Yeah.
And I'll tell you one of the big things here, guys. What I want you to understand is if you have any questions about what Chris just said, if you're a realtor as well, or a loan officer, and you have any questions on any of these programs and want to understand how to exploit markets with niches, the DSCR one still drives me nuts and more loan officers don't take advantage of it. I just, seriously, if I was a loan officer right now, I'd learn everything there is to know about a DSCR loan. Then I'd call a real estate agent up and I would say, pull every multi-unit property that you can get in every MLS and let's see if any of these properties qualify for a DSCR, and then let's go figure out where the buyer is, where the investor is.
Yeah.
You can do that all day long. It would be the greatest icebreaker in the world, and just brainless to do and wouldn't cost you a dime.
I had an old buddy of mine that was a rep for us back in the GMAC RFC days. So it's been a minute. And he worked for us for a while. His name was Mark Weber. He had a saying that he always tout. He's like, your niche will make you rich.
It's true though. I kind of, where you're finding pockets of success, if everybody's going out there and commoditizing themselves and trying to be the low rate leader, and you're still thinking rate and term, and you're trying to compete at 6 7/8 instead of a 7% or 7 7/8 instead of 8%. Everybody's doing that and nobody's getting ahead. Like that's what's happening right now. The only people who are finding success in these markets are the ones who can exploit a niche. You got a million loan officers all trying to be the low rate leader, and nobody is ever the low rate leader. You can buy in or buy out of a market. So like, okay, if everyone does the same thing, then it's the market is going to dictate my success to the lack thereof. So where are you finding opportunity? Just do what other people aren't doing. Find these niches, and these niches will kind of make you rich, or they'll certainly get you through these hard times.
What's interesting is it's mentioned. I've said this quote now. This will be the third time today that I've used it or brought it. Actually, fourth time possibly. Once with my daughter, once with a team that I'm working with coaching, and then once with my sales team. So that'll be the fourth. You have to be willing to do the things that people won't do to be able to do the things that people can't do. And Jerry Rice said that a number of years ago, but it's a great saying. And if you're willing to put in the time and effort to do those things in which people won't do, make the phone calls, to go pound the pavement, to talk to real estate agents, to talk to homeowners, to talk to the guy who owns the duplex, the guy who owns the fourplex, the person who owns the eightplex, whatever it is. If you're willing to go do that extra work and put in that extra time and effort and talk to 100 more people than the next person, then you're going to be successful and you'll be able to have the success that others can't because you're willing to put in the time, effort, and energy. You're willing to make this your career and go swing for the fences. Somebody else isn't willing to do that, and they're going to watch you and be like, "Oh, that's not fair. How do they get that?" Well, it's not fair because you didn't put in the work. So if you want it, you got to go out and get after it.
And and for the hardworking loan officer out there, I mean, this market is a godsend because it's weeding out the weak. It really is. There's a lot of people who can't hack this market, and they're not long for this industry, and that benefits everybody who has staying power.
Two of my sons are account executives that work in our office, and yeah. And it amazes me the times that they call people and like, oh yeah, I still have my license, but I'm not doing law. I shut loans down this year. It's just too. I'm going to do something else. I'm going to just sell solar. I mean, it's like, get it. Yeah. You got to ride the tide, right? But I mean, those successful loan officers, the ones that have been doing this for 20 years or 15 years or whatever it is, and if this is your career, you're a professional. This is your time to shine because, to your point, when they all come back in later, and they will, when rates go down and it becomes easier again, you're going to have your focus, your foundation built, and you'll be able to outstay all of them because you're here, you've been here, and you haven't left.
I just I was talking with a local real estate agent. His name's Tom Rapp, and I know I looked at his MMI numbers. He's done 65 buyer side transactions this year. This is a real estate agent, and I'm in Vacaville. Vacaville translates to Cowtown. I don't live in big city California. I live in Cowtown, California, quite literally. 65 buyer side transactions. if you as a loan officer want to get in his office, you better have something other than what he's already got when it comes to loans. He's not going to have, he would never have a conversation with you, nor would anybody else who's doing that type of volume. The only way you're going to catch the ear of some of these great producing agents who could be that kind of help you through these turbulent and rough waters that we have in front of us with this market, the only way that you're going to have any of those conversations is through talking about niche programs, is through talking about non-QM loans. And reach out to my friends at Oak Tree. They literally have account reps that are just waiting to have this conversation with you right now.
Yep.
Reach out to these guys, have that conversation, and earn your way into some of these top producing agents' office, because I don't see any other options on the table. Well, Chris, thank you so much for your time. Enjoy the rest of your day. Congratulations on the basketball, and I will catch you next week, my friend.
Sounds good.
Thanks, buddy. All right.